Hello and welcome to everyone. Hope you're all doing well and safe. My name is Pratik and I am from the world of financial reporting. Why I am here? The reason why I am here is to make things simpler for you and to help you navigate the world of financial reporting. In this session today, we will be covering a few quick concepts around business combinations. A very important concept, whether you're writing the CA final exam or the Global Financial Reporting Standards paper or are preparing for the ACCA Diploma in IFRS examination. One of the most commonly examined questions or points that we will be covering today include the computation of goodwill or gain on bargain purchase, as well as the accounting for non-controlling interests. We will be also trying to cover some of the key practical nuances that you could face in the world of financial reporting when dealing with the topic like business combinations. So without too much ado, let's straight away get into this topic. A quick recap in terms of what is a business combination. A business combination is a transaction or another event in which an acquirer obtains control of one or more businesses. It is pertinent to note that this definition will undergo a change globally from financial reporting periods beginning on or after 1st of January 2020. Well, IFRS 3 in the current phase applies to all business combinations with the exception of a common control transaction, formation of joint ventures, and asset acquisitions. As a practitioner, a key nuanced point here is that there is a significant difference between IFRS 3 and Ind AS 103. Ind AS 103 also includes guidance on how to account for a common control transaction, something which is not there in the IFRS 3 version. Well, so much for the practitioner's view. With this, how exactly does one go about accounting for a business combination? Let's take a quick look at that. Business combination accounting is a simplified process to describe. The first step in that process is to identify an acquirer and the acquisition date. Next, you measure the consideration transferred. Third, recognize on the books all the measurable identifiable assets and liabilities, measure the non-controlling interests, and finally recognize goodwill or a gain on bargain purchase. Just spending a couple of minutes on some of the key aspects here, which once again may not be relevant from an examination standpoint, but are critical from a practical perspective. First is the identification of the acquirer and the acquisition date. Friends, you may have heard the term reverse merger, wherein a smaller entity acquires a much larger entity. Although the legal acquirer is the smaller entity, from an accounting standpoint, the acquirer is actually the larger entity rather than the smaller entity. And therefore, the business combination accounting triggers in the books of the larger entity rather than the smaller entity. Identify and measure consideration transferred. This is something that we will study in this session today. The key point to keep in mind is that the entire consideration transferred is to be considered at its fair value or is to be determined using its fair value. So if you are exchanging shares, you must take into account the fair value of the shares. If you are exchanging contingent consideration, once again, there is a requirement to fair value that contingent consideration and include that in the consideration transferred. And finally, don't forget, if there is a deferred consideration, which means the payout happens, say 2 years later, then please don't forget to discount it to present value and include that in your computations today, because the business combination accounting is happening today. It's just that the payout will happen 2 years later. Finally, another very critical step in the real world, which is to recognize and measure identifiable assets and liabilities. Friends, you could have a situation where there's an entity that gets acquired which has a great goodwill, which has a great brand name. The brand name does not always appear on its financial statements, but in a business combination, it could be possible that you could now see the brand in the financial statements of the acquirer. So a very important practical step that's part of the business combination accounting. Thereafter, you measure non-controlling interests or minority interests as we commonly understand them in the accounting standards world. Finally, recognize goodwill or a gain on bargain purchase. This is another significant area of gap difference between Ind AS and IFRS. Let's suppose that you paid $100 and in return got assets of $120. There is a gain of $20, which under IFRS gets recognized in the P&L as gain on bargain purchase. But in the Ind AS world, this is a carve out or a departure from IFRS, wherein this 20 rupees does not flow through the profit and loss account. Instead, it gets credited to reserves. With that, let's look at a quick question to try and recap and summarize what we have spoken so far. On the screen, you have a question which says Makers Limited acquired on 1st of June 2018 65% of share capital of D Limited, which is engaged in production of components of machinery. D Limited has 1 lakh equity shares of 100 each. The quoted market price of shares of D Limited was rupees 12 each on the date of acquisition. Fair value of identifiable net assets of D Limited is rupees 80 lakh. Makers wired 50 lakh rupees in cash and issued 50,000 shares as purchase consideration on the date of acquisition. Quoted market price per share was rupees 25 per share. Some additional facts. Makers agreed to pay an additional 15 lakhs if the cumulative profit earned by D Limited exceeds 1 crore over the next 3 years. On the acquisition date, D assessed and determined that it's probable that this extra consideration will be paid. The fair value of this consideration is 9,80,000. D also incurred expenses of 1.5 lakh rupees on the acquisition. The choice by the company to account for non-controlling interests is to measure NCI at fair value. The question for us is, how will the acquisition of D Limited be accounted by Makers under Ind AS 103? So these are the broad facts that we have. Let's quickly look over the facts once again. So Makers is the acquirer. Makers is the acquirer. They are paying 65%. They are purchasing 65% of the capital. The market price per share of D, which is getting acquired, is 12 rupees. The fair value of net assets of D Limited is 80 lakh on the acquisition date. 50 lakh rupees out of that is paid by cash. 50,000 shares are issued at fair value. Now, the important point here is that the quoted market price is 25 per share. Friends, this is an important point which could often get missed in the examination. When you compute the fair value, compute the fair value of the shares, not the face value of the shares. Moving on, the other incremental information is this is an example of a contingent consideration. As we said, all purchase consideration to be at fair value. The fair value of this contingent consideration is 9,80,000. What do we do with the 1 lakh rupee 50,000, 1.5 lakh of acquisition expenses? Do nothing, because this is something that D has paid. It has got nothing to do with Makers Limited. And finally, the accounting policy choice, non-controlling interests are measured at fair value. Now, the first step that you would go about doing is calculate the fair value of the consideration and thereafter compute goodwill. To calculate the fair value of the consideration paid, let's first go back to what's the consideration paid. The consideration paid in our example is 50 lakh rupees of cash, 50,000 shares at a market price of 25 per share, which works out to 12.5 lakh rupees. Additionally, there is a fair value of contingent consideration of 9.8 lakhs. Oh. Yeah. Now, friends, this is only constituting 65% of what Maker has paid. But the fair value of the entire or the net identifiable assets of the company as a whole are 80 lakhs. Therefore, we need to bridge the gap from 65% to 35%. You guessed it right, this is non-controlling interests. Now, because non-controlling interests are measured at fair value, the fair value of the non-controlling interests is 3,50,000 shares into 12 per share, which is 4.2 lakh rupees. Now the fair value of the total consideration works out to 76.5 lakhs. Well, here the acquirer is paying 76.5 lakhs to get assets worth 80 lakhs. This, friends, is a gain on bargain purchase, which under the IFRS world goes through to P&L. So if you're writing your diploma in IFRS exam, this 3.5 lakh rupees goes to the profit and loss account. But if you're writing an examination under the Ind AS framework, that gets recognized as part of reserves. This is an accounting policy choice, friends, whether you want to recognize NCI at fair value or at proportionate share. Let's look at how the accounting would have happened if this was recognized using the proportionate consolidation method. Well, the 65% of the business that Makers has paid remains unchanged. They would continue to pay 50, 12.5 and 9.8. What changes is instead of 4.2 lakhs, you now have 28 lakhs. And that 28 lakhs is nothing else but 35% of 80 lakhs. Now this, friends, takes the total consideration to 100.3 lakhs, against which assets acquired are 80. In this case, there is a goodwill of 20.3 lakhs. As can be seen, the accounting answer in both the situations is completely different. And that's why the accounting policy choices become critical. Hope you found this session useful. Stay tuned. We'll come up with more of these. In the meanwhile, if you need to reach us, please feel free to reach out at the below address. Thank you and have a nice time.